Good morning and welcome to today's webinar, Understanding the Retail Media Opportunity. Thank you for joining us. I'm Connie and I work on the member services team here at the IAB. So retail media has become a real focus area for the IAB this year and is a big part of our plans for 2023. We hosted our first ever retail media roundtable a few weeks ago, bringing together all parts of the retail media supply chain for an in-depth look at the evolving landscape. We had so much demand for that session, we decided to take it online to this webinar format to make it accessible for more of our members. In just a moment, I will pass over to Dr. Daniel Knapp to share the very compelling insights that he presented at the roundtable. But just before I do, I wanted to share 3 key things that we at the IAB are doing next year for retail media. The first is that we are launching a new industry group specifically for retail media. So if you have a keen interest in the sector and you want to have a seat at the table as we work on various initiatives in the space, you are very welcome to join the working group from January, which is when it will be launched. Secondly, we will be introducing retail media into our annual ad spend study, which measures the size of the digital advertising market in the UK. And lastly, but by no means least, we will be adding retail media to our roster of digital upfronts. So come October next year, we will be hosting our very first retail media upfront, which we are really excited about. So that's everything from me. If you do have any questions during the presentation, please just pop them in the Q&A and Daniel will be able to get to them at the end of the presentation. And with that, I will pass over to Dr. Daniel Knapp.
Thank you very much, Connie, and a warm good morning to all of you. I'm excited to be here, and we had the opportunity to discuss this huge potential of retail media already at the summit that Connie mentioned. Today, I would like to, in a sense, repeat my presentation here to a virtual audience to really look at the current state of play of retail media and also its potential in what I call the polycrisis, historically particular times where we both are facing as an overall digital ad industry, cyclical headwinds from economic turmoil, and also, of course, profound structural change that is rewriting the rules how we as an industry operate. And my thesis is that these two forces create a perfect storm that can and will lift retail media very quickly into adolescence. So, for context, I'm the chief economist at IAB Europe and work with IAB UK and also IABs around Europe to really, drive insights and, try to size and understand where things are going. And I think the IAB UK initiative to launch a working group really speaks to how serious we as an industry must take the retail media opportunity. This has nothing to do with retail media, but it really shows, I think, that we are in extremely confusing times. I think we are facing the longest year in digital advertising, in a sense, and similar to what the Romans experienced in 46 BC, what they call the Annus Confusionis, the year of confusion, when they moved from their old calendar, their Roman calendar, which you can see here, to the new calendar, which we know today, because the old calendar had become out of tune, out of whack. They had sometimes more days, sometimes less days. It was changing all the time, and it became far too complex to manage all the different holidays, etc. And they went through a transition period to clean all this up and to move to a new, leaner and standardized system. And doesn't this really speak to what's happening in the ad industry, where we are with one foot still in the old world, for instance, the world of third-party cookies, and with the other foot in the new world, which we're trying to recreate after. And this year 46 BC was the longest year in history because it took 445 days to transition from this old paradigm into the new one. We are also in this limbo period when third-party cookies are going to be deprecated, likely end of 2024. But our longest year is longer than 445 days. Within this metaphorical year, lots of things will change, and it is within this environment that retail media is coming into itself. But we speak about opportunity a lot, but hang on. Can there really be more growth in digital advertising, or are we not facing a digital hangover? In Europe in 2021, we had extraordinary growth of across all countries, 30.5% year on year in terms of the digital ad spend. In the UK, it was even more, north of 40% growth. Can digital retail media really grow more? Or are we not seeing a changing environment where society is not as digital anymore as in the pandemic world? Well, the first thing is we are now in the polycrisis. Welcome. The Germans have a term for a picture like this with arrows and different concerns, Krisenbilder or crisis pictures. This polycrisis, something that you might have seen floating around the FT or some other economic newspapers, particularly pushed forward by the economic historian Adam Tooze, who borrowed it actually from some French philosopher, said this polycrisis is different than other economic crises, in particular different from the Lehman crash, etc., which was in a sense monocausal. We could clearly identify what the root cause of the economic collapse was. In the polycrisis, we got, as you can see on this picture here, different crises happening in parallel, influencing each other, and potentially augmenting each other. And in some cases, in some combinations, they could result in so-called macroscopic events where all bets are off. And the problem for advertising is that this is a new constellation of factors which makes it very hard to predict how will companies react and how will the overall ad economy perform. We know advertising spend is a fickle beast. We know that when GDP goes down, maybe 1%, advertising amplifies that decline and declines by maybe 4, maybe 5%. In this new constellation here, it's not clear. And we are thus facing the polycrisis as an industry, highly uncertain times, characterized likely by short-termism, some growth here and some decline on the other side of the market. What's fueling this further is that the era of cheap money is over. What you can see here, one of my favorite charts, is a 5,000-year history of interest rates. And it really brings home the point that even the ancient Egyptians couldn't borrow money as cheaply as we could still about a year ago. And it was this cheap money that fueled a lot of growth in our industry. A lot of growth came from VC-funded companies who were putting 20, 25% of their revenue into advertising. They used large VC funds to build market share, build awareness, and so forth. Now, in this world where we are focusing less on hypergrowth and more on right sizing and profitability, these companies will struggle to invest as much in advertising as they did before, and they need channels which provide a clear, measurable return on investment. We're also facing an environment where small and medium-sized enterprises, in a sense, the backbone of the digital ad industry, have reached natural spending limits. What you can see on this chart here on the very left is the percentage of a total marketing budget or ad budget that major marketers spend on digital, on 40%. Rest goes in TV, out of home, and so forth. When we look at small and medium-sized businesses, the picture is different. We can see that over 70% of their overall budget is being put into digital. And we're now facing a point where, with signal loss that we have due to ATT, with e-commerce stalling, with consumers going elsewhere, they have reached natural limits in how much they can spend. So as an industry, we can't rely on that fuel anymore. And we can also clearly see that the world hasn't entirely changed, meaning there's less oxygen for digital ad growth when the world becomes, again, more physical. And of course, while correlation isn't causation, I think this chart here depicts the situation quite well. On the one, I overlaid here two things. On the one hand, we can see since IPO, the quintessential pandemic stock, Zoom, where we are today. And we can see the massive rise correlating with lockdowns and then how the stock declined as the world opened up again. And on the other hand, we can see the passenger numbers at Heathrow Europe's busiest airports. And of course, we can see as those numbers went up at the same time, the Zoom stock also went down, meaning we are not in this digital first world. Consumers are elsewhere. And that also puts a damper on digital ad growth. This translates really also into the idea of actually e-commerce overall, where we can see we had a long period of linear growth in the UK here. These are figures from the National Office of Statistics. And then this exponential surge where we were celebrating a 4-year leap within 3 months. However, this exponential growth didn't usher in a new era, but we saw a reversion to the mean, where we saw this exponential growth going back towards a more linear trajectory right now, meaning there's again less potential in a sense. It's not all bad news, because while this exponential surge was happening, as an ad industry and a broader e-commerce industry, we've built an infrastructure that's much more sophisticated than before, able to absorb long-term and mid-term more spend and bring it to work in a better way. But this overall means that the e-commerce growth is facing a downwards correction. So here we can see, on the one hand, Statista forecasts for growth in the UK of B2C e-commerce in Jan 2022, and then another from eMarketer in October 2022. And you can clearly see the massive gap going on here. And this is overall in terms of just what consumers are spending on e-commerce, a £183 billion gap. That, of course, also puts a damper on ad spend. But with all of these factors combined, the question is, are we yet in an economically induced ad recession? Is the overall ad industry feeling this yet? And as I mentioned with the Roman calendar metaphor, we are kind of in two worlds at the same time. For sake of simplicity, I bucketed a range of companies, for better or worse, under the umbrella Big Tech on the left here. This is their ad revenue. On the right hand, I got the agencies in here. I trawled through all of these company reports and put in their total revenue. And something remarkable is happening here. On the one hand, we can see, if we look at the left, we can see that we saw a deceleration of growth, Q2 versus Q1 2022. And some, now, Twitter, Meta really went into the single digits. On the other hand, we can see not only stronger growth overall on the agency side, but also an acceleration of growth. So in two ways, this picture is entirely different. And if we overlay, Dentsu just reported a few days ago, the last of the big agencies, if we overlay the Q3 results here, the picture would look extremely similar, meaning it's not just something that is a short-lived snapshot, but something that seems to be a structural feature. And the key thing is that big tech is impacted a lot by SMEs and also by ATT and that signal loss that we're facing in digital ads, which is less pronounced in agencies with longer commitments, upfront commitments, a different client roster, different channels, etc. So we are not yet in this ad-induced ad recession, in this economically reduced ad recession yet. And I think the headlines in the news really illustrate this. It's not very simple. And far from a doom and gloom scenario, I think there are 5 factors we need to consider to understand the situation that we're in. First, we see mixed signals from different advertisers, not just on the SME side versus the big ones, but even when we look at the big ones, we can see that marketing-driven organizations, i.e. those that drive, that have a large budget and adjust it maybe once a year, they continue to spend, whereas sales-driven organizations would really look closely at how advertising directly drives sales, and the other way around, how many sales there are there to support new ad investments. They are much more aggressively adjusting budgets. We can see this continuation of this divergence between big tech and agencies to continue. The e-commerce slowdown that I mentioned is putting a damper on things as it's about right sizing and profitability. We can see currently that the consumer price inflation is not really sucking energy out of the ad market. It's more about ATT and other factors, because averages in consumer price inflation, they apply, of course, to the whole population. But in particular, if we look at the luxury sector and others, travel sector, they are doing extremely well, meaning there is around 15–20% of the UK population whose consumption habits are propping up the ad industry a lot, as they are not feeling in their pockets the consumer price inflation. And lastly, to make things a bit more complicated, we see a huge influx of new money coming from China. We saw container shipping costs, which skyrocketed during the pandemic, drop down from $20,000 to around $2,000 to ship something from Shanghai to London. And the downturn in the domestic Chinese market means that Chinese manufacturers are eyeing Europe, the UK, and the US as next markets. So this is the polycrisis, which isn't as simple and has push and pull effects. And this means overall that I've revised downwards my outlook for 2023 for Europe overall here, regardless. So I was a bit more optimistic in 2022 in May with a 10% growth, revised it slightly downwards to 7.1%. And then in 2023, I think we need to be realistic and as an ad industry overall, really brace the cold, as there will be a significant downward correction. Digital will fare better than the rest, but it will likely be one of the slowest growth periods in digital advertising that we have yet experienced. Of course, now digital is 60% plus of the overall media pie across Europe. So this is nothing to be too concerned about. Now, once we have this economic picture, the cyclical headwinds that we are facing, there's of course other things happening, in particular on the privacy side, which is completely re-architecting how we as an industry operate. What you can see here is, in a sense, a picture from the history books. It is the telephone tower in Stockholm at the beginning of the 20th century. And each of these cables in here leads to a single household block. What you could do back then in any of those household blocks, you could pick up the phone line and listen in to any conversation that was happening on the phone. There was one line for the entire housing block. And this sparked huge privacy concerns. So each epoch had its own debate about technological advancement versus privacy and how the two can be reconciled. And the Wired magazine of the 19th century, American electrician, commented on this phenomenon like this about the telephone: "We shall soon be nothing but transparent heaps of jelly to each other." This could have been said yesterday, not in 1897, by a privacy advocate criticizing data practices in digital advertising. My point here is the following: that we need to take serious anything that's happening in privacy and try to bring what we want to do as an industry in alignment with cultural and social values, but it's not an insurmountable task. And the time and the moment that we're in, it's not as historically specific as we sometimes tend to believe ourselves. But what is also clear is that this cookieless world will be built on many different pillars. There won't be a single replacement. It's about choice and orchestration of different approaches, which we can place on a spectrum of identifiability, i.e. how close you can get to the real consumer identity, and also how deeply textured that identity is. On the very left here, we got the deep granular understanding of individuals, and then on the right, we move away from individuals towards aggregates, groups, and then at the very end, only contextual signals only, nothing about people at all. And of course, logged in users have a huge advantage here: email address, credit card, overall physical address, purchase history, consumer profiles, and so forth. It used to be the realm of the large big tech players, but increasingly we can see grocers, marketplaces, and others being able to leverage this data in a privacy-safe way for advertising as well. We can see a huge uncertainty in the market as to which of these approaches will prevail, and many are placing bets on different companies with aggressive M&A. We saw this in 2021. This is a global picture about acquisitions in the first-party data space, the ID space, and also in the contextual space. When there's no estimated value on here in the contextual, it just means the value of the deal wasn't publicly disclosed. But this really shows that a lot of bets are being placed on the future, and that this future is both highly, highly important financially, but also uncertain. We talk a lot about our industry, about how first-party data is a panacea to a lot of these pains. But this data needs to be activated. It needs to be used. In IAB Europe, we recently released a study that looked at what's the priority of first-party data for marketers. And many shifted from first-party data to actually second-party data as the priority, as they're struggling to find valuable first-party data in their organizations, or from the CMO perspective, convince other stakeholders in the organization that this data should be used for ad purposes, or find this data, hunt it down in the first place in the organization is a hard thing to do. What we can see here is a quick assessment, in a sense, how ready particular sectors are to use first-party data. And a good indicator, not an only indicator, but a good first shot at this is how close are companies as advertisers in a given sector typically to the end consumer transaction. Because with this end consumer transaction, of course, you can increase the wealth and the granularity of your data. The little smileys kind of indicate here, mapped over share of ad spend on Nielsen figures, how ready a sector might be. Overall, what we can see is that while some sectors are more ready than others, intermediaries, think of retailers, for instance, who aggregate and who represent brands to sell things, can fill in that role of gathering that valuable data that maybe brands themselves are not able to activate or find in the first place. The world is not only changing due to privacy, but privacy itself is changing how the internet operates. This guy here is Walter Ulbricht, a politician from the German Democratic Republic, which a few days before the Berlin Wall was erected, made this bold, obviously false statement. Nobody has the intention to build a wall. And many of us are in a part of the digital ad industry where we speak about the open internet, about interoperability. That is a core tenet of what we do. However, the reality is that increasingly the internet, and with that also ad addressable audiences, are fragmenting. We're entering the age of the splinternet. With each of these here, these different boxes here, in a sense, constituting separate ad ecosystems, and with that, separate internets with their own rules of ad exposure, measurement, conversion, attribution, and so forth, which are not only to a very limited degree interoperable. But these many walls and hedges that are coming up here also present huge opportunities. In particular, when we look at the bottom left here, we can see that the number of walled gardens, hedged gardens that we're seeing is actually increasing. There are over 30 currently globally, and more are coming. It's hard to categorize retail media in this. Is it really a walled garden? It really depends a lot on retailer approaches. You know, a Walmart versus an Albertsons or a Kroger in the US, for instance, they're very different philosophies of how they work with third parties and how open they are about measurement. I think for us in Europe and the UK, one thing is crucial, that the data and the insights coming from retail media presents an opportunity to connect their own on-site walled hedge gardens with the wider internet to activate programmatically and through other means that data and those audiences. The collision of these cyclical and structural trends, economic headwinds and privacy re-architecting the world we operate in, really enables retail media to thrive. Of course, I'm going to show some forecasts here. Forecasts are not reality. Forecasts show potential. So it doesn't mean that things are likely or are necessarily going to turn out this way, but they show where this journey can take us. However, it's crucial that we as an industry gather in working groups to define standards, definitions, and other things to provide the basis for the potential growth to happen in the real world. I think when we look at the potential of retail media, nothing shows this as clearly as this massive divergence in company results. So here we're zooming into Q3, recall the big tech company results. I showed a few slides earlier, and you can really see some are affected by ATT, and others have extremely rich transaction data from consumers, which they can use on and off site. And if you mapped over, for instance, the Walmart results, which came out the other day, you would see that their retail media business grew by more than 30%, underscoring this bifurcation of trends. overall, when we look at where's the potential in retail media, of course, we need companies that sell stuff online. And we're mapped here. These are the top 20 globally by online gross merchandise value. And it's pretty much kind of a maybe 3.5 horse race, which is mainly dominated by Asian companies, with Amazon standing out here as a US firm. Where's Europe? There's only one company in the top 20 in terms of gross merchandise value that can enter the top 20, and that is Zalando, the Berlin-based retailer. Having said that, I think whereas Europe and the UK kind of only, if we extend from the top 20, constitute around 3.1% of global online gross merchandise value, this is going to grow further as we are behind e-commerce penetration, in particular with regards to China. And in a European picture, we can see that the UK features fairly strongly. So here is a zoom in into Europe. This means a ranking of European companies by online GMV. The Union Jack here makes this a bit crowded, and it really shows how many endemic UK retailers and marketplaces there are headquartered in the UK, which provide a huge opportunity for retail media. How huge is it? We can see from some company results, self-declared revenues, that this is a fast-growing market. Walmart makes 2.1 billion, expecting 4 billion. Others marketplaces coming in hot as well. Instacart on track to deliver 1 billion this year. And then if we look at on the right side, we got 2 European players, Carrefour and Zalando, and whereas we can see things are smaller and taking a bit longer, it will not be too long until they reach hundreds of millions of euros or even 1 billion of revenue from retail media. When we look at the UK, we did an analysis on which of the kind of UK headquartered companies by sector actually already has retail media offerings. So we trawled through hundreds of different companies, checked, do they have an online business, and do they have a retail media business on the top of that? So of all the body of companies that have retail media, this is how it's currently distributing. And we can see grocers, fashion, and multi-sector. This would be marketplaces, for instance, dominating this picture currently. When we look at how are launches happening, here are the top 5 in Europe, and we have the IAB Europe numbers here. We looked at how does this picture change in terms of retail media launches between March 2022 and October 2022 for the companies that we can track. And we saw a fairly static picture, France, Spain, and Italy, but we saw a high dynamism in the UK and Germany with new launches coming in, meaning the addressable market and the available supply in these countries is growing. How do we size the market apart from looking at some company results from Walmart? How can we systematically understand what's going on? As Connie said, a proper market sizing is crucial, and the IAB UK is doing that. At IAB Europe, we're doing something similar. But in the meantime, we need to make some informed guesstimates. How can we do this? Here's a little template on a fairly simple approach, but which does seem to be working quite well. I mentioned online GMV a couple of times, online gross merchandise value. And we know from companies who report on retail media that there's a correlation between these, that it makes sense to look at retail media as a share, retail media revenue as a share of online GMV. And we can, once we have this online GMV for companies in the UK, we can obtain this often, need to harmonize the data slightly. We can then say, based on what we see in the US and some results from Zalando and Carrefour and others, what are kind of conservative, likely, and aggressive estimations of retail media as a percentage of online GMV? And then we can look at, depending on how long a company has been in the market, how saturated their page is, for instance, with ads, we can see, are they more in the conservative bucket or more in the aggressive bucket? And it gives us a first reading of how big the market could be. Currently, when we look at Europe, the UK, we find a picture that looks broadly like this. This is just not all retailers we track, but it's just a first snapshot where we can understand how mature is the market. Currently, we see many companies in the nascent bucket where the retail media as a share of online GMV is between around 0.5 and 2%. Many are around the 1% mark. And those companies typically eye a more established business to be achieved in 3 to 4 years. There's a clearly defined landing zone of around 3.5 to 4% of online GMV, where many fall in here. I've excluded on this chart Amazon, as you can see, is a large company with over 9% of retail media share of online GMV, and also Instacart, where the figure is already at 18%, which is remarkable because it's actually driving the overall profitability of this company. But this means if we want to get to 3 to 4% of online GMV, that retail media needs to grow faster than e-commerce overall, which isn't too difficult right now, as we can see the e-commerce market stalling or growing much slower than it was before. But it also, of course, puts some pressure on retail media teams to make this vision work. We believe that they are in for a successful game, as we can see that retail media is likely to outperform the overall digital ad market in the recessionary environment that we are facing, due to the availability of first-party data, closed-loop attribution, the amount of technical spend, measurability coming into this sector. So even in 2023, for instance, by a factor, we believe, of 7.8x. And it's clearly that retail media is the dominant growth driver across European markets, in the UK, Germany, and elsewhere, when we segment this digital ad spend, as I showed before, by format. The most remarkable thing here really is that social is stalling. We see, of course, Instagram surging, but it's mainly a redistribution of spend, not net new money coming into social. And we even see some migration away from social buckets to retail media. Some are saying, well, why is search still growing? Shouldn't retail media cannibalize search? It does in some senses, but we can't yet fully distinguish what is pure retail media and how do we kind of bucket product-based search, right? Should that be part of the search bucket or the retail media bucket? This is on our agenda. But the important thing here is the search market and the retail media market here, they are correlated and there's some overlap in those markets. Let's get into the numbers. Based on what we know from Amazon, we've modeled Amazon numbers for the UK and our retail media share of online GMV model. We believe that the UK market in 2022 is going to be 3.4 billion in terms of spend, reaching around 8 billion by 2026, always within a double-digit growth period. Let's contextualize it a little bit. So the 2021 number for retail media was 2.7 billion, including Amazon, and 2026, 7.8. That's as big as social display was in 28. And the 26 number is as big as search was in 2019. I think these numbers really show that although many retailers are just launching their offerings or in the first or the second year of their journey, retail media overall is not an emerging channel anymore. Well, this poses some challenges. Whereas on the one hand, the overall industry, including Amazon, is huge. On the other hand, we still need to get the basics right. Definitions, market education, standards, look-back windows, harmonization of reporting. So we are, again, like the Roman metaphor, with one step already in the future and with one step still locked in the present, forced to make this future happen. I mentioned Amazon a few times, but it's clear that the UK endemics are growing their market share. It's not just that Walmart outperformed Amazon in the US. We can also see similar patterns happening in the UK. And we see that this is something that's happening long term. It's not just to the nascent nature of many offerings in the UK and the endemic offerings, which are, of course, then kind of growing organically. Spend wants to go somewhere. And the markets of Amazon and grocers are, for instance, quite different. With Amazon, a high exposure to third-party Chinese sellers, which are propping up the market, as I mentioned. Whereas on grocers and on other UK endemics. It's more the large brand advertisers coming in here with trade marketing budgets, shopper budgets, digital budgets, migration from other digital budgets, and also traditional media budgets. So these are, in a sense, two markets often lumped into one, and we all need to get better at distinguishing and disentangling these markets. The UK ad market overall, the digital ad market, sits apart from the rest of Europe. Here we can see a snapshot of 2021 digital ad spend. The size of the bubble is how big was the market. And then we can see signs of how dynamic was the market. This is the growth axis. And then how mature is the market. And this is the digital ad spend per head per capita axis. And remarkably, some markets, of course, the less mature markets are growing strong in some cases. But the UK, so as one of the, or as the most mature market, also still has strong growth, meaning despite the fact and the maturity, or maybe because of it, it can absorb more spend coming from other media into this market due to measurement standards, the perceived benefits of digital, etc. So this is a good launchpad for the UK market to really unlock the potential of retail media. Much easier than in some of the other large European economies, like Spain and Italy, with massive media markets, but not massive digital ad markets. A lot of money remains locked in TV, where that migration might be a bit harder to do. Overall, we see that the UK, again, including Amazon, has the largest retail media market in Europe, second only to Germany. But there's a huge headroom for other markets to come into play as well. And the headroom is being expressed on this slide here in terms of retail media share of overall e-commerce spend in that market. And the average for the e-commerce spend, which are the dots above the bars here, is that purple horizontal line. So many markets are still immature in terms of retail media share of the e-commerce spend, and we expect them to grow. So for anybody who is a UK retailer, but with eyes in other European markets, international expansion should certainly be discussed. Important, I think, is that retail media doesn't just refer to the potential of advertising on the website or the app of a retailer or marketplace, but it extends far beyond that. This is, I think, where this chart here really fits in with the Splinternet chart I showed earlier, where activating insights and data from retailers, putting that into social, search, programmatic, or CTV channels. Think of the announcement now with Tesco Boots and ITV, for instance, really drives more spend. At some point, sites, apps will be saturated in terms of ad units, CPMs, and so forth. So the long-term opportunity really is to move retail media into an omni-channel environment, always with the added benefit of being able to measure who came back to the retailer page and who really bought the stuff. And the offsite opportunity also means that the addressable market for retail media expands from endemic brands, i.e. brands that are just being sold on the retailer page, to those which are not being sold there, but where the retailer data can be activated or some other media strategies. In terms of measuring the spend coming back, of course, the question is, where is the attribution? Should we really use the last click attribution models, or should we do something more sophisticated? The risk currently is that we, in a sense, regressing to a model that we had already departed from in other parts of the digital ad industry. So some work to be done here by trade bodies. I think crucially, it's not just about spend overall, but it's also retail media about feedback loops, insights, product development, where it's not just about media, but more about retail overall. We did some surveys and understood, based on advertisers, mainly FMCG advertisers, to understand what do they actually want to do with retail media? How are they using it? Of course, media buying is top of mind, but also how can I develop my brand and my products better? Which tweaks should I make, for instance, to improve my products? Or when I launch products, to concept like fake door testing, or putting a product on a retailer site that doesn't exist yet and see what's the consumer perception. These are extremely valuable things, in a sense, live research, which retail media can offer. Often we speak about the rich data, but that data isn't always available from retailers. And brands really demand more insights, not just in terms of how did the ads perform, but also what kind of can be gleaned from transaction data and other types of insights. Overall, I think it means that retail media isn't just a media play, but it is where we what has potential to go, where we as an ad industry always wanted to be outcome driven and more intertwined with the overall commerce workflow. What you can see here is a typical waterfall chart of cost allocation within e-commerce. And there's the bucket of SG&A, services, general and administration. A very boring accounting term where marketing and advertising is in there. And this is hugely variable, 25 to 35%, meaning when we have signal loss due to the splinternet, due to a lack of tracking and so forth, the cost of customer acquisition, retention, and upsell is going to go up. If one works within a retail media environment, potentially one can mitigate that signal loss and make ad pounds work better, meaning the efficiency of ad spend goes up and the size of this bucket can go down, meaning if done well, with all the right reporting and the right data, retail media can contribute to increasing the overall profitability of e-commerce models. And this means to me that really we need to look at this in a broader way, that we need to bring, when we think about retail media, different markets together. Marketing, advertising, clear, but also rents, physical store rents, and also shipping. I think these are increasingly one markets. With rents, it's pretty clear in terms of physical shelf space, we have virtual shelf space. What's happening with shipping? I think when we answer these questions, it becomes clear. We as marketers have typically asked, what does it cost from a message to generate a certain response from a consumer? Awareness, purchase, and so forth. And other people in the organization have asked this, what does it cost my goods to reach a customer? That's what the COO, the CTO, etc. has asked. If I sell stuff online, can I make this, can I deliver this in a profitable manner? How can I enhance the profitability of that? For smart marketers, these are two parts of the same coin. And some retailers like Carrefour are already producing offerings that bring the media part and the retail part of this together in one, where ads for products are being shown to customers who live closer than others to a fulfillment center or who live somewhere where their costs of fulfillment are lower than elsewhere. Meaning, again, that if we use it properly, retail media can contribute directly to the overall product profit margins of an e-commerce-based business. It's early days, but I really think that retail media, despite all the challenges we need to solve in the industry, can emerge as a moat in this highly uncertain world, i.e. a business that can, for retailers, but also for brands and agencies, build walls, become a structural feature that protects ad spend against the uncertain environment that we're seeing, and that really enables new ways of doing commerce. Lots of work to do, but I think in an IAB context, with all you on the call and in the working group, we have the potential to tackle that. And with that, thank you very much, and back to Connie.
Thank you very much, Daniel. That was fascinating. And thank you everyone for joining us today. If you do have any questions, please feel free to get in touch, and hopefully we will see some of you at our last Thursday club tonight, where this month's theme is sustainability. So look forward to seeing some of you there. Thank you very much.